now with more is Gregory Daco. He's chief economist at EY. Gregory, it's good to see you, of course. Your first appearance here on our show in 2026. And as we start this new year, how does the economy look to you?
I think the economy looks generally still quite robust. We're still seeing growth momentum at the end of 2025 that is providing solid impetus when it comes to economic activity. We still have consumers spending. There is greater polarization within the consumer spending environment, with higher income individuals better able to spend and lower to median income families having to dip more into their savings and use more credit. So there are fragilities underneath the surface, but overall the momentum is still positive, with growth of the US economy around 2.5%. But there is a very important development, which is that we are currently in a jobless expansion. We're not seeing much job growth, and we are in this environment where there are downward pressures on real disposable income growth, which could put a bit of a risk for the U.S. economy as we navigate through the rest of 2026.
We are going to see that first Fed decision of 2026 on Wednesday. The market's pricing in a 97% chance that the Fed keeps rates steady on Wednesday. What do you think is the right course of action for the central bank?
I think what markets are pricing in is appropriate given the current circumstances. We are in an environment where essentially inflation has not risen as much as initially anticipated as a result of the tariffs. We're still in this pass-through process from the tariffs, but we anticipate that inflation will likely stabilize around 3%, which is not excessively alarming. And we anticipate that inflation will come back down towards 2.5% by the end of this year. On the labor market front, yes, we are seeing that over the last 3 months, we've had a loss of an average of 22,000 jobs per month, but the unemployment rate is not moving up, which gives you an indication that a lot of the decline in payroll growth is coming from a negative supply shock to the labor market. The key question for Fed policymakers is, how close is monetary policy to neutral, that point at which monetary policy is neither expansionary nor contractionary? And that will be the key source of the debate over the coming months as to whether the Fed wants to clear the bar in terms of further easing, or whether it feels comfortable with the employment and inflation data being where it is.
Gregory, how closely were you monitoring the developments out of the World Economic Forum in Davos, Switzerland last week? And does that change the game at all when it comes to the economic setup here in 2026?
I think what was very interesting coming out of Davos was this contradiction between, on the one hand, the politics talking about rupture, risk, and retreat, and on the other side, business leaders talking about growth potential, about the potential for AI to drive economic activity, for greater deals, and still a globalized economic environment. I think what's key really in this environment is that we are in a new paradigm where supply shocks are increasingly dictating economic activity, and where we're seeing the advent of the economics of necessity. Essentially, business leaders are increasingly going to be driving growth focused on the different supply shocks, from trade policy to industrial policy to the advent of AI, immigration developments, and demographics. All of these factors are shocks that business leaders are integrating, and they're now using this uncertainty as a new normal when it comes to driving business activity. I think this offers opportunities to those business leaders that have understood this new economic paradigm and are ready and willing to drive growth.
I do want to get your take on artificial intelligence, Gregory, because we see companies citing AI as changing their own staffing when it comes to 2026. And we saw some of that in 2025 as well. How much is AI driving this economy and productivity?
I think what's very interesting in the US economy right now is that the strong wave of productivity growth precedes AI. That is not to say that AI will not be a further driver of productivity growth, but what we've seen over the past 3 years is essentially an environment where businesses have been in a cost control mode. They value their talent. They want to ensure longer tenured employees, better trained employees, more efficient processes, and a higher return on investment given the high interest rate and the high cost of capital. That productivity is organic. On top of that, we're going to see AI actually drive further productivity growth, and that is a benefit for all actors of the economy, because higher productivity means you can grow at a faster pace without the inflationary pressures that have been hurting the US economy over the course of the past few years. So it's really the holy grail that we're starting to see in terms of productivity momentum. And that is really something that we should continue to sustain and continue to drive for.
You know, a winter storm has been sweeping the entire country, and certainly the Northeast has bear the brunt of it these past few days. Gregory, any data, any models that you're following that shows how this has impacted the economy?
Generally speaking, whenever you have natural disasters, you tend to have disruptions to private sector activity. Now, this winter storm came through largely on a couple of weekend days. So in terms of disruptions to economic activity, there was a moderate effect. We did see that there were a lot of disruptions to travel activity. And of course, some of the outdoors activities are going to be constrained as a result of the cold temperatures, as well as the winter storm and the snow. So you're likely to see somewhat of a restraint in terms of economic activity in the US in the first quarter because of that. But I would not expect a visible drag in terms of GDP growth. It's going to be very localized as to where you see what sectors and what regions you see slight disruptions in terms of economic activity.
All right, Gregory Daco, Chief Economist at EY. Gregory, good to see you, and thanks again for joining.
Always a pleasure.